Hello friends, this is Vijay Bamvani here and I'm back with you in this video to talk about what to expect in the market ahead and what a tumultuous week it was. If you thought the volatility was bone crunching, do remember that in my past videos, which you're seeing on your screen and thumbnails of these videos, I had told you based on the impetus oscillator that the markets were going to make explosive one-sided moves and you should be extremely cautious and be prepared for such moves. Now, is the volatility over? What happens in case the war escalates or maybe even de-escalate? What should you expect in the month of March? We're going to do all that in this video. Number one, what you need to know is that Russian ambitions or area of interest, as Putin calls it, is not restricted to Ukraine. All right. Now, the history is that Mikhail Gorbachev initiated glasnost in 1990, and that resulted in the splintering of many countries away from Russia, and Putin wants to unify these countries. Number one, it makes economic sense. Their natural resources come to Russia. Ukraine, for example, is very rich in natural resources. It's the breadbasket where grain is grown and exported from, for example. It's rich in metals. It's rich in fuels. So when you bring these countries back into the Russian fold, you also get their resources. Secondly, it gives you an extension to your political career. You also tend to get more popularity at home. So he will not stop here. He will go to the Balkans where there's even more oil and gas. So you have Lithuania, Latvia, Estonia. You have the other Baltic nations. The list goes on. So this kind of volatility is something that you will have to learn to live with. As a matter of fact, in 2014 and 15, when this issue cropped up, I had commented on my social media pages. You can see the screenshot on your screen as to how this is just brushing the dust under the carpet and it will keep resurfacing at a later date. This is precisely what is likely to happen from here on. So let's just get used to it. Life will go on, business as usual after a period of time, and markets will just get a lot more volatile. Now, coming up on your screen is the market roundup window, which tells you that the Nifty fell a little more than the bank Nifty. This is because the broader market sold off, and the reasons are not very far to seek. You have the US dollar index, which is almost 0.5% higher on a week-on-week basis. You have oil and gas, which jumped up. Now, these are extremely inflationary times. And when you have oil and gas prices going up, it just adds on to that inflation. Bullion, both gold and silver, saw week-on-week gains, even though on Friday they surrendered a lot of gained grounds after nerves calmed down about Ukraine war ending very quickly. But still, you can see that gold and silver almost inched up to between 1/4 and 1/3% on a week-on-week basis. The dollar index rising capped the gains in gold and silver, but for which it would have gone even further. The USD INR rose 1.18%. Now that's double jeopardy as far as we are concerned, because number one, our fossil fuel prices are going up. Number two, the dollar just went up by 1.18%. So the landed price of fuels in India is that much more expensive. And in the month of March, we are expecting fuel price hikes, and major ones at that. So inflation is likely to jump. The 10-year benchmark bond yield rose 1.50%. Not surprising, because the markets are expecting a lot more inflation and interest rate hikes in the coming days. Friends, do remember what I told you about the NSE market capitalization. We have lost 4% on a week-on-week basis. Now, this is a threshold that I told you is a danger mark as far as I'm concerned based on empirical evidence. I've been trading these markets since 1986, and I can tell you with a little bit of hindsight of past experience that a fall of 4% or higher in market cap on a week-on-week basis for a couple of weeks always unnerves the markets and leads to big falls. So whether it's stopping at 4% because it was war last week, or is it going to continue in the coming week, will determine what really happens. The MWPL fell from 28.63 to 19.53 last week, which is very natural because it was an expiry week and not everybody rolls over their positions to the next derivative cycle. Now, the overseas cues were mildly positive, and that's frankly all thanks to the gains made on the last day of the week, that is Friday, in spite of which the Dow Jones Industrial Average closed the week with net loss of 0.06%. Not very big, but then it still remains under pressure. Now, what's worrying is that the Nasdaq has recorded a death cross where the 50-day moving average is below the 200-day moving average, which means the medium-term trend has now turned bearish, and the average holding price of the medium-term buyers is now below the long-term average of buy and hold investors. So that kind of is a negative portent for the Nasdaq, which is not surprising. You've seen a whole lot of weakness coming in our technology stocks as well. Watch the Dow Jones because even that is approaching a death cross. At the end of this video, I have a few words of what you can expect in March, because the markets are going to get extremely tricky as we head towards March, and the reasons and the what, where, why, how is something I want to discuss with you towards the fag end, so do stay with me. So friends, you're seeing the MWPL chart on your screen. That's a precipitous fall. I drew your attention to the fact that the MWPL has not even gone to the 30 levels. And historically, we've seen in the week prior to the expiry, a peak is normally made between 32 to 35%. Those days are gone. We essentially peaked out at 28.63 in the February expiry. We did not even visit the 30 mark. So the two Marshmallow guys are basically showing lack of buy conviction. Now, what is the Marshmallow theory? It's a behavioral finance-based study. I have covered it in the video whose links you're going to find in the description segment below this video, as also on the end screen. So the two Marshmallow guys are basically cautious, which tells me that I must be cautious as well. Now let's take a look at the stock and index futures turnover in the derivatives segment. Do remember, this is a cumulative turnover of three concurrent derivative series, which is March, April, and May. You're seeing a week-on-week decline in stock futures turnover. The big peak is because of rollover. So when you square up your February futures and initiate the exposure in March, the turnover logged is double. That big spike is because of the rollover. The index futures turnover is significantly higher as compared to the previous week. As you can see the numbers, that's because traders have taken refuge to intraday trades in the indices, which happen to trade not more than 2% on an average day on an intraday basis where volatility is concerned, whereas stocks can gyrate between 3 to 4%. Now, we'll see the basis. The basis is the premium enjoyed by the future over the spot. We are seeing both indices showing basis inversion, which is the future is trading at a discount to cash because of selling pressure. The fact that the new derivative series offers 1 full month of playing around to a derivatives trader did not help matters. In spite of that, there is a discount in the futures to cash, and not only is there a discount, but the short seller is still willing to sell even at inverted rates. Now, this is something that you need to watch. Last week, I pointed out to you that the basis was inverted on 3 out of 5 trading sessions, and that led to a bigger fall. In the coming days, if the basis remains inverted for extended periods of time, that is not exactly good news. Now, basis is something you need not look too far. I update it on my social media accounts every day. So do connect with me on these contact coordinates that you're seeing on your screen, and we can basically help each other become better traders. Coming to the advanced decline ratio, this is a do-it-yourself kind of an indicator. No rocket science involved here. We are basically comparing the number of gaining shares compared to the number of losing shares. Now, on Friday, euphoria came back because people thought the war in Ukraine is going to end sooner rather than later, and therefore buying emerged. To the extent, for every one falling share, there was a 5.31 number of shares rising. So the gainers outnumbered the losers by a factor of more than five times. This is the highest in the 20-day period chart that we have seen. Can it be sustained? I really don't know, because this is an unprecedented kind of a jump. You went from 0.08 to 5.31. Logic tells me that this kind of a quantum jump may be very difficult to sustain, but we're going to look ahead. Now let's see the impetus chart. Now this is something that you have come to love, to depend, and to basically bank on. But do remember, where the impetus is concerned, or even the lift, weight, thrust, drag index is concerned, it will become powerless if a new geopolitical or any other natural reason which will come to disrupt the market. For example, if there is a war and the tide suddenly changes, the indicators cannot tell you that. If there's an earthquake while we were sleeping, if there's an earthquake in America, it can't tell you anything about that. So when the news flow is going to determine market trends, these indicators become a little powerless. But they can still help us as to what will happen when the market normalizes. So what the impetus indicator was telling me, and I told you this in the last couple of videos as well, was that explosive moves were coming because the impetus was falling constantly and it was being compressed like a spring, which would bounce back at a short notice. And that is clearly what it did. Unfortunately for the bulls, the impetus is rising when the markets are collapsing, which tells me that pressure is building on the upside, and markets are likely to seek equilibrium on the downside. There is an exception. Like I told you, I have a special few ideas to share with you about what to expect in March. Do stay with me till the fag end of this video. So very high volatility ahead because markets have fallen on rising impetus. What you are seeing is that on Friday, the bank Nifty impetus fell noticeably and the Nifty's impetus gained very, very marginally in spite of the fact that the market jumped. So the impetus has risen on 4 days when the markets were falling, and the impetus has either become flat or has fallen on the 1 day that the markets have risen. So the impetus is not really very, very impressed with what happened on Friday. Now for the lift, weight, thrust, drag indicator. This is something that I have started sharing with you very, very recently. If you love the impetus indicator, you'll love this one as well. Now let's see what's happened here. The Nifty, and this is the spot Nifty, gain or loss over the previous day in percentage terms. So obviously no prizes for guessing. On Friday, the Nifty jumped significantly and the lift, weight, thrust, drag index also went up, but a whole lot more cautiously, which means it's not very convinced that the rally is extremely strong. Do remember, the impetus actually fell for the bank Nifty and it almost flatlined for the Nifty 50. Would I call the lift weight thrust drag reading as lift, or would I call it as thrust? Because it's not weight, it's not drag. If I had called it lift, which means the markets are going to soar, they're going to soar up in the sky like an aircraft. And if I call it thrust, it means the markets want to rise, but there is still some amount of hesitation. The hesitation comes from the fact that the lift weight thrust drag indicator has not risen as sharply as the Nifty percentage gain loss. So, on the side of for the sake of caution, and just to be sure that I err on the side of caution, I'm going to call it thrust rather than lift. Lift would be fly, 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 fly. All right. Thrust is an aircraft is taxiing on the runway, preparing to take off. Let's now go to the footprints of the four categories of traders in the markets. We are going to begin with FIIs, the foreign investment institutions. As you can see on your screen, they've increased their stock futures long positions over the previous week, almost doubled it. And as far as their index net long positions are concerned, they've trimmed it somewhat, but then they've compensated by more than that by increasing their stock futures exposure. Now the DIIs, the domestic investment institutions, they basically squared up some of their shorts in stock futures, whereas their index futures net shorts have actually gone up. So they remain cautious. They're not much of a change. As a matter of fact, their index futures, they've added on to their shorts. Now, for the last two categories of traders, which I value more than the previous two. Prop traders. Now, these are extremely sharp, extremely savvy traders. Brokers own trades, so they know who's buying and selling. Therefore, it tells me what the almost insider segment of the market is thinking. These guys have trimmed their individual stock futures long positions marginally. But they've covered their index shorts and actually turned long, because they were net short on the index last week, as you can see on your screen, and they are now net long, but a very small quantum. But what's interesting is that they are cutting short their individual stock futures longs. Whether this is expiry related or because they are nervous, the coming 3 or 4 trading sessions will tell us. Now, friends, we are going to the retail index exposure, which has fallen on the long side. And if you see the retail stock futures, their net long positions have also eased off. So the retail has cut their long positions down marginally, and in individual stocks significantly. I told you last week as to how really impressed I am with the fact that the retail segment is showing extreme amount of savvy, and they are basically showing a whole lot of maturity by exiting long positions whenever they feel that the markets are giving them a threat perception. So since they are the biggest holders of long positions, their unwinding is likely to have a lot of bearing on the market, which is why I feel that prop and retail are giving me a warning sign, an orange light. Hey Vijay, everything is not well. Friends, let's now go to the 10-year benchmark bond yield, which I told you has gone up on a week-on-week basis. No, basically prizes for guessing that the bond markets are actually expecting an interest rate hike and inflation to jump. Let's not forget oil and gas have jumped significantly. The dollar has jumped. So we are going to be what the economists call import inflation. We are going to be importing inflation from now on. So what I would watch is whether the 10-year benchmark bond yield crosses the Rubicon of 7%. Am I expecting a crossover of 7%? Possibly, yes. In the month of March, I think we might cross 7%, and that is something that's going to be not a very welcome sign for the equity markets, just to put it mildly. So do keep watching the bond yields extremely carefully, especially if you're a banking stocks trader or even a bank Nifty trader. The bond yield has an extreme amount of determining influence on bank Nifty as well as banking stocks. Let no one tell you otherwise. I basically think that bond markets are actually a lot more important where Qs are concerned for equity markets, both banking and non-banking. And I don't see why people don't really look at the bond prices a whole lot more often. I'm going to keep you updated. Do follow me on social media. I continue to advocate laddering in bonds. What is laddering? I'm going to make a special video, a short one, like I have started off late making short videos midweek, and I'll explain to you what laddering and yield flipping is all about. So if you're doing laddering in sovereign bonds or sovereign investments, a bigger picture here, continue to ladder, because I do think that that sticking to the plan is the way to go forward. Friends, I now come to the US dollar index, which is basically going to be a trend determinator for a whole lot of emerging markets, India included. Now, the Dixie, as it is popularly known, has risen on 2 out of 5 trading sessions last week, and as you can see on the daily chart on your screen. But those two gains, and especially the one on Thursday when the news of the Russian attack on Ukraine came, was big enough to take away the thunder of any mid-cap stock. Although the closure, as you can see, on Thursday was way off the intraday highs, but that was enough to make the Dixie record day or week on week gains in the positive segment. The trend line that I have drawn since June last year is acting as a beautiful tried and tested trend line. The price is staying above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So as long as it stays above the average, the bulls are going to be incentivized to hold their existing long positions. Switching now to the weekly chart on your screen, we are seeing the trend line which we had seen on the daily line hold beautifully well, and the price is above its 25-week exponential moving average, which is a 6-month long holding on cost. So even the medium term outlook remains positive for now. And last week, I advocated a range between 97 and a quarter on the upside and 94.95 on the downside, which was unfortunately breached on the upside because the high was 97.73. Nobody had any control over that shock of Ukrainian territory being breached by the Russian military machine. So in my defense, I would say it was an unexpected surprise. In the coming week, I expect an estimated range between 97.75 on the upside and 95.40 on the downside. I think volatility is likely to remain. So will the levels be breached? I think it's very, very possible. So let's be careful out there. Friends, the US dollar index done. I now turn to the Bank Nifty, which fell on merely 2 out of 5 trading sessions. But as you can see on the daily chart on your screen, the falls were big, number one. Number two, the fall was with a big gap on Thursday, obviously because the shocking news of Russian attack on Ukraine, and that gap is yet to be filled. So what we are seeing is a huge one marshmallow selling on the Bank Nifty. What is the marshmallow theory? I have explained to you in my previous videos, and the links are to that video in the description segment and on the end screen of this video as well. Now, a couple of notable points here on the daily chart. Number one, the Bank Nifty never really went above its 25-day exponential moving average all 5 days of the week. And this average is a month-long holding on cost of a bull, which is actually a partial picture because you're not seeing the cost of carry, the rollover cost that a bull incurs. All right, the STT, GST, etc., does not show in the chart. And the number two aspect is that the 25-day exponential moving average is itself turning lower. So unless the bulls keep the Bank Nifty trading above 38,000 in the coming days, I would say that the pressure is likely to remain. I would want you to be careful out there. Let's now go to the weekly chart, where what we are seeing is a bearish candle coming after two long leg dojis. Now, this is something that I covered in my last week's video as to what long leg dojis are and how they basically indicate indecision. Coming at a swing high, they might even say that the bulls are cautious, which is what happened. As a matter of fact, I did my video thumbnail itself last week was that bulls are appearing exhausted. So this big bearish candle on your screen has closed below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which tells me that this correction is extremely serious. Last week, I even went out on a limb and I told you that statistically speaking, this is the first major correction after the rally started in the end of March or early April 2020. And this is something that I even wrote in my Live Mint column, the URL to which I share on my social media pages as well as on YouTube in the community text messages. I said that this is the first big correction coming after March 2020, and therefore bulls need to be extremely careful. Now, the medium-term outlook has also been violated because the 25-week exponential moving average has been breached on a closing basis. Your last mile support for the Bank Nifty is at 34,000. If even the 34,000 level is breached, I think the bulls are clearly on the ropes, and they are going to suffer a lot of discomfort in the weeks ahead. In the week before last, this index was number 4 on the most volatile list counters on the NSE derivatives space, but it moved up one notch to number 3 because the volatility actually jumped. Last week, I advocated a estimated range between 39,300 on the upside and 35,750 on the downside, which was unfortunately breached again because of a gap down open, because we saw a intra-week low of 34,990. So we actually fell by as much as 760 points below where I expected support, but then nobody expected war. In the coming week, I expect an estimated range between 38,200 on the upside and 34,500 on the downside. Friends, the Jensen's measure and the Traynor ratio, etc., are screaming for caution. So avoid very big ticket exposure because volatility can cut you both ways. And like I told you earlier, do remain with me till the end of this video. I'm going to tell you what I expect in March. The Bank Nifty done, my friends. I move on to the Nifty 50, the most liquid derivatives counter on the equity derivatives exchange. It's also the lowest impact cost counter out here. And what we are seeing on the daily chart on your screen is a very prominent and a very pronounced decline because this index has fallen on 4 out of 5 trading sessions. It stayed below its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the guys who are holding long positions, even if you don't count their holding on, the rollover cost, which is not reflected in a chart, are under severe amount of pressure. Last week, I pointed out to you that a bearish triangle was forming and that triangle was breached by the gap down open on Thursday. Even though Friday the markets have rallied, the lower trend line is still not tested. Will the Nifty attempt to close the gap between Wednesday's closing and Thursday's opening? I think it's quite possible. But unless the Nifty trades above its 25-day exponential moving average and the previous swing high somewhere at around 17,600 or 17,650. That's a tall order. That's about 1,000 points from here. I think the bulls are likely to try and exit their existing long position. So the pressure at higher levels will remain. Technical analysts call this overhead supply. Overhead supply comes from people who are stuck at higher levels and are existing their long positions, which are distressed, and they basically want to curtail their losses and go home. Turning to the weekly chart here, what we are seeing is that the price has closed below its 25-week exponential moving average, which is a 6-month holding on cost of a bull. Like I told you last week itself, this is again the first serious correction coming in after April or March or April 2020. Look at how the 25-week exponential moving average is also flatlining and beginning to tire out. So it's time for abundant caution. The medium-term outlook also appears tired. I'm not saying bearish, I'm saying tired. Please mark my words here. And I'm going to explain to you at the fag end of this video why, when, what, how you should be watching out for yourself. Now, in the week before last, this index was at number 11 of the most volatile list. It rose 3 notches to place itself at number 8 on the most volatile list. That's because volatility indeed did jump up sizably. Last week, I advocated a range between 17,900 on the upside and 16,550 on the downside, which was again like in the case of Bank Nifty breach because the intraweek low was 16,203. So I missed the support area by a good 347 points. But then these are war times. The coming week is likely to see a range between 17,275 on the upside and 16,000 on the downside. And I tell you again that the markets are likely to be extremely news driven. So will the levels be breached on either side? I really can't say. The jury is out there and we are all dependent on the news. Friends, the index section done. I now come to the most popular segment of the market where I give you 5 stocks that are high beta, high impetus. So you take small exposure, wait for large price moves, and 5 stocks that are low beta, low impetus where you take big exposure, play on small price moves. Why the difference? Because different traders, different mindsets, and therefore different techniques. Now the high beta, high impetus stock list is led by Indus Tower at number 1, BPCL at number 2, Escorts at number 3, Tata Consultancy Services or TCS at number 4, and Multi Commodity Exchange or MCX at number 5. The low beta list, on the other hand, is led by Intellect Systems, number 2, Asia Brown Boveri ABB, number 3, Metropolis Labs, number 4, Muthoot Finance, and number 5, Honeywell Automation. Friends, a word of caution here. This hierarchy of stocks changes day to day and volatility expands and contracts every hour. So do keep connected with me. Stay connected with me on my social media accounts wherein I update these aspects of trading so that you can stay ahead of the curve at all times. Now friends, for the update that I told you, I want to talk to you specifically about in this video. You see, March is not your average run-of-the-mill month. A lot of money changes hands in March. We balance our books, we pay our last installment of advanced taxes. The mutual fund industry, which is holding billions of rupees, needs to disclose its annual NAV. So far, it discloses the NAVs every quarter. So a whole lot of gravy dressing, window dressing, buttering up of prices also takes place. So on one hand, you're going to see nervous individual retail traders who are basically trying to exit at cost. And on the other hand, big money is by way of fund managers trying to boost up their NAVs so that they can attract even more money in inflows from their mutual fund schemes. So there is going to be a pull and push. So don't expect the month of March to be any cakewalk if trading profits is something that you're looking at from intraday or even swing trading basis. This is a very challenging month, and you need to be extremely careful about how you deploy your money. I keep telling you that your money are your chess pieces. The market is like the chessboard. Our job is to see to it that our money is moved from one chess square to the other so that it gives us the optimal bang for the buck. March is going to be challenging, my friends. Do buckle up. Where the overall market reading of the Jensen's measure and Trenor ratio is concerned, I think the challenge just went up multifold, which is what is statistical beta is telling me market wide. And I keep telling my followers on social media, always keep an eye on the bid and offer spreads. Since October, I have been warning you that the bid and offer spreads are too hostile. Now, I've recorded videos on this in the past. You can check those out in the playlist and the hyperlinks in the description below. I've given you why you should be watching this aspect of the market. And as long as the bid and offer spreads remain high, it means that the retail trader is always going to be at a disadvantage, which is you and me. So let's be careful out there and handhold each other. Connect with me on social media, like I've told you, and we can get conversations going and help each other become even better traders. Friends, before I sign off from this video, there are hyperlinks to my playlist on Equity Master YouTube channel. I put up a couple of trading ideas there as well. Do subscribe to my playlist, and there's an offer of a free trading guide from Equity Master in PDF format. Do avail of this wonderful opportunity as well. And if you liked my video, if you like our work, please subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh content being put up out here. And I'd love to hear from you about our work and the new indicators that we are keeping on launching, and we are going to keep launching even in the future, as to what you think about our work and how we can get it even better. And friends, request for help here. Please help us to reach out to fellow like-minded investors and traders by referring my video to your family and friends. I thank you for your patience and sticking with me in this slightly longer than usual video. This is Vijay Bambwani signing off for now. Do take very good care of yourself and your money. Till we meet again next week, have a very, very profitable week ahead. Bye-bye for now.